understand definitions given under this standard, like cash, what is cash, cash equivalent. Then we'll discuss the presentation of these cash flows under operating activities, under investing activities, and then finally under financing activities. Under operating activities, we'll briefly do an illustration as they are presented into direct and indirect method. Then we will quickly discuss identifying type of cash flows, how our various cash flows are required to be identified into either investing, financing or operating activities. They are broadly certain examples. Then we'll do reporting cash flows on net basis, whether cash flows can be reported on a net basis or not. Then we'll do non-cash transaction, how non-cash transactions are required to be disclosed. Then we'll understand presentation of certain special items. Post that, we'll do two illustrations to understand and conceptualize our knowledge on cash flow statements. And finally, we will discuss the disclosure requirements. So friends, let's first come down to the first agenda item of introduction. In this, we will understand how statement of profit and loss is different from the cash flow statement that we are presenting and understanding under this standard. So friends, if you really see, the statement of profit and loss reports only the profit and loss made during a period. However, the cash flow statement helps a reader and the entity itself to understand and describe how the company is generating and using cash and cash equivalents, and which are distributed across its various activities. The cash flow statements that are required to be presented as part of a financial statements are to be prepared as per Accounting Standard 3 issued by ICAI. This accounting standard is mandatorily required to be carried out by certain entities, and for other entities it is optional whether they can choose not to prepare or they can choose to prepare this cash flow statement under this accounting standard. So let's understand what all entities are required to prepare cash flow statement under this accounting standard 3. The standard is mandatory for level 1 enterprises in respect of accounting periods commencing on or after April 1, 2001. What are these level 1 enterprises? These level 1 enterprises have the same definition as given by the Institute of Chartered Accountants of India and also by the company's accounting standard rules. The level 2 and level 3 non-corporate entities as defined by the Institute of Chartered Accountants of India, and level 2 corporate entities, which are also called small and medium-sized companies by the company's accounting standard rules, are encouraged but not required to apply the standard. So it's only the level 1 enterprises which are required to prepare cash flow statements. However, level 2 and level 3 entities and the SMCs, as they are called, are not required to prepare the cash flow statement, but they can choose and opt to prepare the cash flow statements under this accounting standard. So if you really see friends, all listed companies, if you have seen the financial statements of listed companies, all listed companies in India are required by clause 32 of the listing agreement of the Securities and Exchange Board of India, which is SEBI, to prepare and present cash flow statements by indirect method in accordance with Accounting Standard 3. What is this indirect method? What is this part of? How is it presented? We'll understand in the foregoing slides. So now let's understand what is the purpose and scope of cash flow statements. The purpose of cash flow statement is to provide information about the historical changes in cash and cash equivalents of an enterprise by means of a cash flow statement. So it really gives a user of a financial statement an understanding that how the cash, which was the opening balance, has moved on and what have been the changes across various activities to reach to the closing balance, how the company has generated cash and how has it used cash across its various activities. The purpose is also to classify these cash flows into operating, investing and financing activities. We'll understand and discuss them in greater details in the foregoing slides. The scope of this standard is that an enterprise should prepare a cash flow statement and present the same along with the financial statements for each period. So basically, this means that the companies who are required to, which are level 1 enterprises, to prepare the cash flow statements should present the cash flow statement as part of their financial statement. So it becomes an essential part of a component of their financial statement. So a company is preparing balance sheet, is preparing profit and loss account, and is required to prepare cash flow statement should prepare cash flow statement and give the related notes to form a complete set of financial statements. So now let's understand what are the various benefits of cash flow statement. The cash flow statements provides information that enables users to evaluate the liquidity and solvency positions. By this, we mean that a user, by understanding and analyzing the cash flow statement, can understand what is the liquidity position of the entity, whether it would be able to meet its current liabilities out of its current assets, whether it generates sufficient cash to maintain its working capital, whether it generates sufficient cash to meet its long-term liabilities. Thus, a cash flow statement helps in understanding the liquidity and solvency position. It helps in assessing the ability of the entity to generate cash and cash equivalents. By analyzing the cash flow statement and by understanding the classification of cash flows into operating, financing, and investing activities, a user can basically analyze and understand what is the ability of the entity to generate cash and cash equivalents. Again, whether these cash and cash equivalents are sufficient as per the requirements of the entity. It also enables to develop models to assess and compare the present value of future cash flows of different entities. So by this, we mean that by understanding the cash flow statement of the current period, one can prepare a model what would be the future cash flows, whether the cash inflows or cash outflows in the coming, say, next 3 years, 5 years, 7 years. So management today are able to, basically prepare the models, the cash flow, you have heard, if you have heard about discounted cash flow techniques, etc., etc. They are able to prepare such models basis the cash flow statement of the entity. Where are these models used? These models can be used in various aspects like impairment analysis of the entity or of the asset, the valuation of the entity, what is the total value of the entity. So all these future cash flow models are used in assessing various aspects and important aspects. The cash flow statement also enhances the comparability of different entities because it eliminates the effects of using different accounting treatments. How does this happen? This happens because if you want to compare the profit and loss statement of a Tata company and of a Reliance company, it might be come out differently because they might be applying different accounting standards, or they might be applying different choices given under different accounting standards. So accordingly, it might be a case where those profit and loss statement of a Tata company and of a Reliance company would not be comparable. However, if you compare the cash flow statements, that would eliminate the effects of using different accounting treatments, and accordingly they will be more comparable. The cash flow statements are useful in examining the relationship between profitability and net cash flows. It helps to understand how the cash flows have helped in generating the profit, what is appearing in the profit and loss statement, or how the profits in the profit and loss statement have helped in arising, in giving, or in generating or using the cash flows as given by the cash flow statement. So they complement each other. So the next agenda item is the definitions. We'll understand certain definitions, how are they defined under this accounting standard. So the first definition is cash. Cash itself, we are preparing cash flow statement. So how are this cash defined in the accounting standard? Cash comprises cash on hand and demand deposits with banks. Demand deposits are deposits which can be withdrawn without prior notice. For example, balance in current account with banks. So cash would mean the cash which is on hand of a company or which is in the demand deposits with banks, like the current accounts, which can be demanded upon at any time without prior notice being given to bank. So friends, the next definition is of cash equivalents. Cash equivalents are short-term, highly liquid investments that are readily convertible into known amounts of cash and which are subject to an insignificant risk of changes in value. So they are basically held for purpose of meeting short-term cash commitments rather than for investment and have a short maturity of 3 months or less. So basic example would be of fixed deposits having maturity of less than 3 months. They are always readily convertible into known amount of cash. So whatever fixed amount you have deposited, so at least you will get your principal amount, and whatever interest is for 3 months if you withdraw them. So such fixed deposits are subject to an insignificant risk of changes in value. So because these fixed deposits have been guaranteed by the bank that these will be given along with a particular rate of interest, so the risk of changes in value is minimal. So they are different from investment in equity shares, for example, which are always subject to significant risk of changes in value. So cash equivalents are more like fixed deposits or small investments which can be readily converted into cash and are not subject to risk of changes in value. So the next definition is of cash flows itself. We have understood cash, we have understood cash equivalents. Now let's understand what do we mean by cash flows. So cash flows is nothing, and simply put, these are the inflows and outflows of cash and cash equivalents. Combined manner, these are called cash flows. So let's come down to our next agenda item, which is presentation of cash flows. So we have briefly discussed introduction, what are the various definitions as in the cash, cash equivalents and cash flows. Now let's understand how are these cash flows are required to be presented under this standard. So friends, let's understand the presentation of cash flow statement. In the presentation of cash flow statement, you'll basically see that the cash flows are classified into operating activities, investing activities and financing activities. What are the various examples of these operating activities, investing and financing activities? What are the various components? What do we basically mean by them? We'll understand as we move ahead in this session. The classification by activity allows users to assess the impact of those activities on the financial position of the entity and the amount of its cash and cash equivalents. So basically, a user of financial statements, by reading the classification of cash flows into operating, investing and financing activities, would help them to understand how are these cash flows kind of classified into them, how is the cash being generated under just operating activities or under just investing or financing activities, and accordingly how are they being used. So moving ahead, let's now understand the first part of presentation of cash flows, which is operating activities. Now the agenda items also mentions direct method and indirect method. We'll understand that as we move ahead. Let's understand operating activities. Operating activities are the principal revenue producing activities of the entity. So basically, whatever is the revenue producing activity of the entity. For example, for Infosys, the revenue producing activities are sale of software or customization of software. So its cash flow from operating activities would only reflect its revenue producing activities, which in Infosys case is sale and customization of software. Cash flow from operating activities indicate the extent to which operations of the enterprise have generated sufficient cash flows to maintain operating capability of business. Thus, the operating activities, by analyzing the cash flows from operating activities, one can understand whether sufficient cash has been generated from the operations to meet the daily expenses of those same revenue producing activities. Thus, it helps one to understand the liquidity position of the entity. The transactions relating to operating activities are included in determination of profit or loss for a period. Thus, only and only the items in the profit and loss account generally help to determine the cash flows from operating activities. So we'll now basically see certain examples of operating activities and what are the items that you will generally see in the cash flows from operating activities. So examples of cash flows from operating activities could be like cash receipts from the sale of goods and the rendering of services. So an example that I took of Infosys, the cash receipts from sale of software or customization of software or basically maintaining the software, which are rendering of services in Infosys case, would become part of their cash flows from operating activities. Cash receipts from royalties, fees, commission and other revenues is another example of cash flow from operating activities. Cash payments to supplier for goods and services. So, for example, Pepsi, the cash payments it makes to its various suppliers of goods and services, which may be sugar, which may be like the glass bottles that it uses or the PET bottles that it uses, would become part of its cash flow from operating activities. Cash payments to and on behalf of employees is another example of cash flow from operating activities. So basically the salary payments that we make to employees or any advances, for example, received from employees, would become the part of their the cash flow from operating activities of that entity. Cash payments or refund of income taxes unless they can be specifically identified with financing and investing activities. So generally, if you have received income tax refunds or you are making advance tax payments, they would generally be classified as cash flows from operating activities unless they can be specifically identified with financing or investing activities. So during the agenda item of operate cash flows from operating activities, we also kind of discussed that direct and there are two methods, direct and indirect methods. So let's understand these two methods of reporting operating cash flows. So the methods of reporting are direct method and indirect method. The direct method is considered more appropriate than the indirect method. However, the indirect method is the most commonly used method by companies in India to present cash flow statement. And if friends you remember from the initial slides, all listed companies under clause 32 of SEBI are required to prepare cash flow statements by indirect method. So as a result, the indirect method becomes more popular. However, both methods are very important from the examination point of view and we should understand both of these. So friends, let's understand the direct method of presenting the operating activities. The direct method helps to provide information which may be useful in estimating the future cash flows. Thus, as I discussed earlier, the direct method will better help basically in preparing the various future cash flow estimation models which may be used in various aspects like valuation, impairment analysis, etc. Information about major classes of gross cash receipts and payments may be obtained either from the accounting records of the entity or by adjusting sales, cost of sales and other items in statement of profit and loss for changes during the period in inventories and operating receivables and payables, other non-cash items, other items for which the cash effects are investing or financing cash flows. So basically, in the direct method, as examples you saw earlier, like cash receipts from customers or cash payments to suppliers can be either obtained from the accounting records directly or by adjusting the sales, cost of sales and other items in the statement of profit and loss for their basically opening and closing balances, which would kind of negate the adjustment for the non-cash items. So friends, let's see one basic example how cash flows from operating activities are presented under the direct method. As you see, examples could be like, as we discussed, cash receipts from customers. This is presented as a cash inflow and a positive item. Cash paid to suppliers and employees is a cash outflow that comes as a negative item. This will give you net cash generated from operations. Then another example we discussed was income taxes. So income taxes paid would come as a cash outflow as a negative item, and then finally you will reach net cash generated from operating activities if it's a positive, or net cash used in operating activities if it's a negative item. Now let's come down to operating activities presentation under the indirect method. Now, until now we have discussed the direct method of cash flows presentation for operating activities. Under the indirect method, net cash flow from operating activities is determined by adjusting the net profit or loss for effects of changes during the period in inventories or operating receivables and payables. So basically, the changes in the working capital items or the current assets and liabilities are adjusted under the cash flows from operating activities under this method. Also, the non-cash items such as depreciation, provisions, deferred taxes, unrealized foreign exchange gain and losses are adjusted to remove the non-cash items effect and to bring in just the cash profit or loss. Other items for which the cash effects are investing or financing cash flows are also adjusted back to the net profit or loss, and these are then presented into either investing or financing cash flows respectively. Friends, let's see a pro forma of cash flow from operating activities by indirect method. So in this pro forma, you can see we start with profit or loss for the period, which is generally before taxes. Adjustment for non-cash items is done as we saw in the previous slide. We adjust for non-cash items like depreciation, foreign exchange loss which are unrealized, investment income, interest expense, and income tax expense which are deferred and current, which may be basically either investing or financing activities, which we'll see later. Post these adjustments, we'll arrive at operating profit before working capital changes. Then we will adjust for working capital changes like increase in trade and other receivables, decrease in inventories, decrease in trade payables. So friends, here you should remember an increase in current asset would give you a cash outflow. Why? Because if there is an increase in current asset, that means you have not received any cash. So a net increase would generally mean there is a cash outflow. However, if there is a decrease in a current asset, for example, decrease in debtors, that would mean the decrease is only because you have received some cash from debtor. This will come as a cash inflow. Similarly, this holds true for current liabilities in the opposite manner. So for example, decrease in trade payables. This would mean that you have paid out a creditor, and that's why there is a decrease in trade payables, and this would come as a cash outflow. Similarly, an increase in trade payable would come as a cash inflow because you have not paid anything and thus you have saved on your cash, and this would mean net cash used. These would generally mean there is a cash outflow. However, if there is a decrease in a current asset, for example, decrease in debtors, that would mean the decrease is only because you have received some cash from debtor. This will come as a cash inflow. Similarly, this holds true for current liabilities in the opposite manner. So for example, decrease in trade payables. This would mean that you have paid out a creditor, and that's why there is a decrease in trade payables, and this would come as a cash outflow. Similarly, an increase in trade payable would come as a cash inflow because you have not paid anything and thus you have saved on your cash, and this would mean there is a cash inflow. After the working capital changes adjustment, you will reach cash generated from operations. You make adjustment for income taxes paid, and then finally you reach net cash from operating activities if it is positive. If it is negative, you will reach net cash used in operating activities. So friends, after understanding the operating activities and how direct method and indirect method are applied to arrive at operating activities cash flows, let's do certain illustration to better understand how direct method and indirect method is used to calculate cash flows from operating activities, and finally how they are presented. So illustration 1. Given below is the statement of profit and loss account of ABC Limited and relevant balance sheet information. So statement of profit and loss of ABC Limited for the year ended 31st December 2010 is given as revenue items. Sales is 4150, interest and dividend is 100, stock adjustment 20, total of revenue is 4270, expenditure purchases is 2400, wages and salaries is 800, other expenses 200, interest 60, depreciation 100. So this total is 3560. Profit before tax comes out at 710. Tax provision is given as 200. Profit after tax is 510. Balance of profit and loss account brought forward is 50. So profit available for distribution is 560. So statement of profit and loss account continued. Appropriations, transfer to general reserve is 200. Proposed dividend is 300. Dividend tax is 30. So total is 530. The balance after all appropriations in the profit and loss account is 30. So in this question, in this illustration, relevant balance sheet information is given as follows. The debtors have a closing balance of 400 and had an opening balance of 250. Inventories have a closing balance of 200, opening was 180. So again, this is an increase. Creditors, closing balance is 250, opening was 230. Outstanding wages, closing 50, opening 40. Outstanding expenses, closing 20, opening 10. Advance tax, closing 195, opening 180. Tax provision, so in the profit and loss statement the tax provision was 200, so closing is 200, opening was 180. So advance tax, if you see, was paid was equal to the tax provision of last year. Question is, compute cash flow from operating activities using both direct and indirect method. So first we will see how operating activities cash flows are kind of computed using direct method, and then we'll see the indirect method. So let's come down to the solution. Computation of cash flows from operating activities using the direct method. So basically in the presentation we'll make this kind of table having particulars and amount. We'll start with cash receipts. Cash sales and collection from debtors, which is sales plus opening debtors minus closing debtors. This is the way to calculate the cash sales and collection from debtors using the balance sheet item and the profit and loss item. So if we see the numbers, it is 4150 plus 250, which was the opening balance, minus 400 the closing balance. You arrive at 4000. Cash payments is cash purchases and payment to creditors, which is basically purchases plus opening creditors minus closing creditors, which is 2400 plus 230 minus 250, and you arrive at 2380. Wages and salaries paid, again after adjusting for opening and closing, you will arrive at net cash outflow of 790. Cash expenses, again after adjusting for opening and closing, you will arrive at 190. taxes paid. So the advance tax as given in the balance sheet will be the actual tax paid by the entity, by the ABC Limited, which is 195 in this case. So total of B, which is the cash payments item, is 3,555. So cash flow from operating activities would be 445, which is a positive item, and thus it's a cash flow from operating activities. So now let's come down to computation of cash flows from operating activities under indirect method. So if you remember, we start with profit before tax. We adjust for non-cash items. We adjust for cash flows which are either financing or investing. Then we do the working capital adjustments, and then we finally arrive at cash flow from operating activities. Please remember, under both the method, the answer would be same. So answer cannot be different under these two methods. So we'll start with profit before tax, which is 710. We'll add non-cash items, which is depreciation given in the question. We'll add interest, which is a financing cash flow, which we will have a better understanding when we do that part, 60. We subtract the interest and dividend incomes, which are investment cash inflows. We also adjust for taxes paid. Since it's an advance tax paid, as we discussed earlier, the taxes are to be generally taken as operating activities unless they can be specifically identified to financing or investing activities. We do working capital changes. There was increase in debtors from 250 to 400, thus it's a negative cash outflow, 150. Inventories, same case, increase by 20. Creditors, they have reduced from 250 to 230, thus a 20 cash inflow. Similarly for outstanding wages and outstanding expenses, which both come at 10 each. So the working capital adjustment totals to 130. After doing all these calculations and summing them up, we'll arrive at cash flow from operating activities, which is 445, and the answer is same as cash flows from operating activities under the direct method. So friends, after understanding operating activities and the two methods, direct and indirect methods, to compute and present cash flows from operating activities, let's come down to cash flows from investing activities. So friends, cash flows from investing activities are the transactions that affect the purchase and sale of fixed or long-term assets and investments. So these are basically the cash flows that represent the expenditures made for resources intended to generate future income and cash flows. Again, the basic examples would be the receipt and payments relating to like fixed assets. For example, Pepsi invests in its plant and machinery, which is a fixed asset for Pepsi, through which it produces various inventories of Pepsi, of other items, which it sells through its network, and this helps it to generate future income and cash flows. Other examples could be investments in shares, warrants, or debt instruments of other entities. So for example, Pepsi invests in like a company and invests in such a manner that it becomes a subsidiary. This will help it to generate future cash flows for the Pepsi group on a consolidated basis, and thus it becomes an investing activity. Another example could be loans and advances made to third parties. So these loans and advances would be generally made to earn some interest income, and thus they also become investing activities. The next agenda item would be understanding and discussing the cash flows from financing activities. So cash flows from financing activities would be transactions that result in changes in size and composition of owner's capital and borrowings of the entity, So these are the activities which are useful in predicting claims on future cash flows by providers of funds. So financing activities are the activities which help one to understand how the cash flows have been financed, and on the back of it, what are the interest payments or similarly dividend payments are required to be made on those financing activities to the providers of funds, and accordingly one can estimate what are the uses, what are the sources of cash, and accordingly what are the uses of cash. Examples of cash flow from financing activities would be like cash proceeds from issuing shares, cash received from debt instruments, cash repayment of amount borrowed and buyback of shares, cash payments for interest on borrowings, and dividends. So basically one can, by combining cash flows from operating and financing and investing activities, one can analyze what are the uses of cash, what are the sources of cash, whether the cash generated from operations or from financing activities is sufficient to meet its uses by terms of in investing activities or by meeting its working capital requirements, or also the interest payments on financing activities. And thus one can estimate whether it is cash healthy and what are its future cash flows expected, and finally how the growth is projected basis those cash flows. So friends, after understanding the operating activities, investing and financing activities, let's understand certain types of cash flows. How do we identify them to either operating, investing or financing activities? So let's do a brief introduction on the type of cash flows. Cash flows type depends on the business of the enterprise and other factors. For example, principal business of financial enterprises consists of borrowing, lending and investing, and accordingly interest earned on loans given and interest paid on loans taken are operating cash flows for financial enterprises, and investing or financing cash flows for other enterprises. So basically, if you really see, the type of cash flows, whether it is to be classified as operating or is to be classified as financing or investing, really depends on the type of business of the enterprise. Now let's understand various types of cash flows and how are they required to be classified into either operating or investing or financing cash flows. So for financial enterprises, loans and advances given and interest earned in the ordinary course of business is operating cash flows. However, for non-financial enterprises, loans and advances given and interest earned on them is basically investing cash flows. Loans and advances given to subsidiaries and interest earned on them are investing cash flows for all kind of enterprises. So any kind of loans given to subsidiaries and interest earned on them would be investing, or they would have to be classified as cash flows from investing activities for all kind of enterprises, whether they are into financial business or not. So similarly, loans and advances given to employees and interest earned on them are operating cash flows for all enterprises. Advance payments to suppliers and interest earned on them are again operating cash flows for all enterprises. For non-financial enterprises, interest earned from customers for late payments is again operating cash flows. So thus we see that employees are always related to operations of the company, and thus they should always, all the transactions related to employees, all the cash flows related to employees should be classified as operating cash flows. Similarly, transaction with suppliers or customers for all kind of enterprises should be classified as operating. So now let's come down to loans, advances taken and interest paid. For financial enterprises, loans and advances taken and interest paid on them in the ordinary course of business are operating cash flows. However, for the non-financial enterprises, loans and advance taken and interest paid on them would be financing cash flows. Why? Because they have taken loans and advances to finance their operations, and thus any interest paid on them would be financing cash flows. However, again, loans and advances taken from subsidiaries and interest paid on them would always be investing cash flows. So anything, friends, related to subsidiaries, any transactions related to subsidiaries would always be classified as investing cash flows. Since subsidiaries are basically investments for the entity, and thus all cash flow related transactions with the subsidiaries would always be classified as investing cash flows. Thus we saw loans and advances given to subsidiaries and interest paid on them, and loans and advances taken from subsidiaries and interest paid on them would be investing cash flows. Continuing with loans and advances taken and interest paid. For non-financial enterprises, advance taken from customers and interest paid on them would be operating cash flows. Interest paid to suppliers for late payments would again be classified as operating cash flows. So if you see any transaction with customers or suppliers, whether normal business transactions or different kind of transactions like advances or interest paid, would always be classified as operating cash flows. Similarly, interest taken as part of inventory cost in accordance with Accounting Standard 16 would be operating cash flows. Thus, if you see, friends, if the base thing like customers, suppliers, inventories form part of operating activities, their related transactions would always form part of operating cash flows. Similarly, subsidiaries, the basic base item subsidiaries forms part of your investing activities, and thus any transaction related to subsidiaries would form part of your investing cash flows. Now let's come down to identifying type of cash flows related to investments made and dividends earned. For financial enterprises, investments made and dividends earned in the ordinary course of business would be classified as operating cash flows. However, similar transactions for non-financial enterprises would be classified as investing cash flows, because non-financial enterprises are not into the business of investments. Thus, investments made and dividends earned on them would not be revenue generating activities for them, and thus any transactions related to them would be classified as investing cash flows. For all enterprises, investments in subsidiaries and dividends earned on them would be classified as investing cash flows. So as I discussed, if it is subsidiaries, any transactions related to them, any cash flows related to them would be classified as investing cash flows. So friends, let's come down to dividends paid and income taxes paid. For all enterprises, dividends paid would always be financing cash flows. Similarly, for all enterprises, tax paid on operating income would be operating cash flows. So friends, in relation to taxes, if you remember, we discussed that generally the tax payments would be classified as operating cash outflows. However, if they can be specifically identified to investing or financing activities, they would be classified accordingly. So here is an example: tax deducted at source, income. So if concerned income is operating income, TDS deducted on such income is operating cash flow. However, if concerned income is investment income, example, interest earned, TDS deducted on such income is investing cash flow. Thus friends, if an entity has made investment in debentures, then any interest earned on them and any TDS deducted on such income would be classified as investing cash flows. So we discussed about tax deducted at source when they are income. Let's come down to tax deducted at source when the base item is an expense. So if concerned expense is operating expense, TDS deducted against such expense is operating cash inflow. If concerned expense is financing expense, example interest paid, TDS deducted on such expense would be classified as financing cash inflow. So friends, for example, if an entity has taken loans from a bank, that loan would itself be classified as a financing cash inflow. Any interest paid on them on those loans would be classified as financing cash outflow, and any TDS deducted on such expense would again be classified as a financing cash flow. Thus again, one has to understand what is the base item being classified as. So in this example, the base item, which was loan taken from bank, was classified as a financing activity, and thus the interest paid and the TDS deducted on such item was also classified as financing cash flow. So let's come down to identifying types of cash flows in case of insurance claims received. Again, the basic premise will remain the same. If the base item is classified as operating or financing, the insurance claims would also be classified accordingly. So for example, for all enterprises, insurance claims received against loss of stock or loss of profits shall be classified as extraordinary operating cash inflow. However, for all enterprises, insurance claims received against loss of fixed assets would be classified as extraordinary investing cash inflow. Friends, if you see, if the insurance claim was received due to loss of stock, because stock or inventory is classified as operating cash flows, the related insurance claim would also be classified in the same manner. However, in case of loss of fixed assets due to, say, for example, fire, since fixed assets, any changes in fixed assets is classified as investing cash flows, the insurance claims received on them would be classified as investing cash inflow. Because insurance claims are related to events which are not in the ordinary course of business, these are generally classified as extraordinary. So now we come down to identifying types of cash flows in case of profit or loss on disposal of fixed assets. Profit or loss on sale of fixed assets is not an operating cash inflow. Again, the basic premise is, since fixed assets themselves are classified as investing cash flows, the related profit or loss or the cash inflows due to sale of fixed assets would be classified as investing activities. So if you see, the entire proceeds of such transaction be taken as cash inflow from investing activity. Any profit or loss adjustment should be done in the indirect method by starting profit before tax and then adjusting them for profit or loss on fixed assets, and the entire proceeds from sale of fixed assets should be classified as investing cash inflow. So friends, after understanding operating activities, financing and investing activities, and identifying various type of cash flows to either operating, investing or financing activities, let's understand whether cash flows can be reported on a net basis. That means, for example, purchases of fixed assets can be net off against sale of fixed assets. Is it allowable? Or receipts from customers can be adjusted against payments to suppliers? So in this topic we'll understand this. So friends, paragraph 21 of AS3 forbids netting of receipts and payments from investing and financing activities. Thus, cash paid on purchase of fixed assets should not be shown net of cash realized from sale of fixed assets, and these two should be shown as a separate items in your cash flows from investing activities. For example, if an enterprise pays rupees 50,000 in acquisition of machinery and realizes rupees 10,000 on disposal of furniture, it is not right to show net cash outflow of rupees 40,000, which is net of 50,000 minus 10,000. However, there are exceptions to this rule which are stated in the following slides. Cash inflows and outflows related to a particular type of transactions can be reported on net basis in following cases. Cash receipts and payment on behalf of customers, for example, cash received and paid by a bank against acceptances and repayment of demand deposits, can be net off. Cash receipts and payments on behalf for items in which turnover is quick, amounts are large and maturities are short. For example, purchase and sale of investments by an investment company. So investment companies' investments would be like of maturities which are really short, the amounts involved would be large and the turnover would be quick. Thus, they can be classified on a net basis and presented accordingly. In case of financial enterprises, cash flows may be reported on a net basis in the following three circumstances. Cash flows on acceptance and repayment of fixed deposits, cash flows on placement and withdrawal deposits from other financial enterprises, cash flows on advances and loans given to customers and repayments received therefrom. Thus, in case of financial enterprises, the cash flows can be presented on net basis in the given three circumstances, which are basically related to their operations. So if you really see, for financial enterprises, fixed deposits, acceptance and repayment, withdrawal deposits and placement of deposits with other financial enterprises, and also advances and loans given to customers and repayments received therefrom are all operating activities for the financial enterprises. So now let's understand non-cash transactions, which can be generally in the case of investing and financing transactions, how they are required to be presented under Accounting Standard 3 cash flow statement. So friends, non-cash transactions, which may be either investing or financing transactions that do not require the use of cash or cash equivalents, for example, issue of bonus shares, should be excluded from a cash flow statement. However, since they have been excluded from a cash flow statement, there is also a requirement to present such transactions elsewhere in the financial statement. So, such transactions should be disclosed elsewhere in the financial statements in a way that provides all the relevant information about these investing and financing activities. So generally, in cases of issue of bonus shares and other such non-cash transactions, the entity would or should basically are required to give information of these transactions in their notes to accounts. So the entities would present these piece of information which cannot be given in the cash flow statements in their notes to accounts by way of descriptive note. So friends, after understanding the presentation of cash flows into operating, investing and financing activities, understanding how to identify different type of cash flows to these activities and certain other topics, let's come down to presentation of special items, how these special items are required to be presented and classified under operating, investing or financing activities. So friends, first item under the special items that we'll discuss is extraordinary items. Extraordinary items would generally carry the same meaning as given to them by Accounting Standard 5, which is net profit or loss for the period, prior period items and changes in accounting policies. The extraordinary items are disclosed separately as arising from operating, investing or financing activities. Thus, if the extraordinary item relates to operating, then it should be classified as cash flows from operating activities, and similarly for investing and financing activities. This will enable the user to understand its effect on present and future cash flows of the entity. Thus, if there has been an extraordinary cash receipt of insurance claim due to loss of stock due to fire, a user of the financial statements, by analyzing the operating cash flows of that entity for that year, can understand that a huge cash inflow has come into the entity due to such insurance claim, and thus it should be removed while analyzing the liquidity and solvency position of the company or for the purposes of any investment in that company. So the second item in presentation of special items is foreign cash flows. In this scenario, we translate at the exchange rate at the date of cash flows, that is cash flows in foreign currencies and cash flows of foreign subsidiaries. So basically friends, in case of foreign currency cash flows, to present them into our cash flow statement, we translate those foreign currency cash flows at the exchange rate at the date of cash flows for cash flows in foreign currencies and cash flows of foreign subsidiaries. The cash flows in foreign currencies can be like purchases from a foreign seller or sales to a foreign customer. For example, Infosys makes sales of its software to its customers in US and thus receives cash flows in foreign currency in US dollars. Those cash flows are required to be converted into the cash flows of local currency at the rate of exchange rate prevalent on the date of cash flows. Similarly, cash flows of foreign subsidiaries, for example, Infosys again has a subsidiary in US. So any transactions with that foreign subsidiary are required to be converted at the exchange rate on the date of cash flows. Unrealized gains and losses from changes in foreign currency exchange rates are not cash flows. Thus, any unrealized gains and losses incurred in profit and loss account as a result of Accounting Standard 11 application will have to be adjusted, and that gets adjusted under the indirect method and automatically gets adjusted in the direct method. So unrealized gains and losses from changes in foreign currency exchange rates are required to be adjusted, as these are basically non-cash items. Only the realized gains and losses are the real cash flows and are taken into account while preparing the cash flow statement. Now a case comes of if the cash and cash equivalents are themselves foreign currency denominated. How are they required to be presented in the cash flow statement? In that scenario, the effect of exchange rate changes on cash and cash equivalents in foreign currencies is shown as a reconciling item between cash and cash equivalents at the beginning and as at the end of the period. Thus, if your cash and cash equivalents, for example, foreign currency deposits, which become part of your cash equivalents, are there, they are required to be presented in your cash flow statement by means of a reconciliation as at the beginning and end of the period. The next item under our special items discussion is acquisitions and disposals of subsidiaries and other businesses. Under this, we disclose separately the aggregate cash flows from acquisitions and from disposals of subsidiaries and other businesses. These are required to be classified as investing activities. So, friends, the cash flows from acquisitions and the cash inflows from disposals of subsidiaries cannot be net off, and they are required to be shown separately by classifying them as investing activities. We are also required to disclose an aggregate in respect of both acquisitions and disposals during the period, the consideration paid or received, the portion of the consideration paid or received settled by means of cash and cash equivalents, amount of cash equivalents acquired or disposed, amount of assets and liabilities other than cash and cash equivalents acquired or disposed. These are required to be given in a summarized manner. Thus, these disclosures come as part of notes to accounts where there is acquisition and disposal of subsidiaries, and this gives more useful information to the reader of financial statement. So friends, after understanding presentation of special items and after understanding the entire presentation of cash flows, let's do certain illustrations to just consolidate on our understanding and just test on our knowledge. So friends, illustration 2 is basically an abstract of cash flow statement given of Alpha Limited, and we are required to prepare a cash flow statement using that abstract. Thus, it is given as inflows and outflows. The opening balance of cash and bank is given as 10 and 70,000 respectively. The share capital, shares issued, is 5 lakhs. So friends, if you see, this should be your financing cash flow. Collection from debtors is 3,50,000. So where collection from debtors is the word used, it should really trigger in your mind that this is operating cash flows under the direct method. Then you see sale of fixed assets. This should be your investing activity. Payment to creditors, again operating cash flow under direct method, 90,000. Salaries and wages is employee related expense, which should be again your operating activity of 25,000. Payment of overheads is given as 15,000. Again, this will be related to your operating activities since overheads arise in your operating activities. Fixed assets acquired is again an investing activity given as 4 lakhs. Debentures redeemed is given as 50,000, and this should again kind of click in your mind that this should be your financing activities since debentures are being redeemed and debentures help you to source your capital. Bank loans repaid is 2,50,000, and again this should be your financing activity because you would have taken bank loans and that's why you are repaying them. If you have taken bank loans, that means that is you are financing your cash flows through them. Taxation amount is given as 55,000. So this again should be your operating cash flow since no other information is given. What kind of taxation is this? Dividends for all enterprises, if you remember, are financing activities, and thus 1 lakh should be given as part of your and disclosed as part of your cash flows from financing activities. And the closing balances of cash and bank are 5,000 and 10,000 respectively. So friends, after understanding the items given in the question, let's prepare the cash flow statement. So the cash flow statement for the year ended 31st March 2011 will look like this. Cash flow from operating activities will have the following items. Cash received from customers as given in the question, 3,50,000. Cash paid to suppliers is 90,000 since it's outflow, it's a negative item. Cash paid to employees, salaries and wages is 25,000. Other cash payments, overheads, since they relate to operations, again forms part of operating activities, 15,000. Thus the cash generated from operation is 2,20,000. Income tax paid as given in the question was 55,000, which is an outflow and subtracted. Thus the net cash from operating activities, which is a positive item, is 1,65,000. Friends, now let's classify the balance items into either investing activities or financing activities. Cash flow from investing activities would have payment for purchase of fixed assets, 4 lakh. Proceeds from sale of fixed assets is 70,000. Thus, the net cash used in investing activities is 3,30,000. Therefore, friends, if you see, since it's a negative item, we are using the word net cash used in investing activities. The cash flow from financing activities would have proceeds from issue of share capital, which is 5 lakhs, bank loan repaid, which is 2,50,000, debentures redeemed, which is 50,000, and dividends paid, which are 100,000. Thus, the net cash from financing activities is 1 lakh. Thus, the balance part of the cash flow statement will have net decrease in cash and cash equivalents, which is 65,000, which is the sum total of all the above three, which is operating, investing, and financing activities. Cash and cash equivalents at the beginning of the year was 80,000, 70 plus 10,000. Cash and cash equivalents at the end of the year was 15,000. Thus, this tallies because 65,000 is negative, 80,000 is positive. We add the two, we get the cash and cash equivalents at the end of the year 15,000, and thus the cash flow statement tallies. This is how, friends, we are required to prepare cash flow statement, by putting in the items and classifying them correctly into operating, investing, and financing activities. And the net answer, the net increase decrease in cash equivalents after adjusting for the opening balance of cash and cash equivalents should match with our cash and cash equivalents at the end of the year. So friends, if you really see, illustration 2 was prepared using simply the summarized cash account. To further learn the technique of preparing cash flow statements from comparative balance sheets and profit and loss account, we will go through the next illustration in the foregoing slides. So let's do this illustration, which will be more comprehensive and will more challenge your knowledge and help you better understand the whole entire topic. So friends, let's do this illustration 3, which is more comprehensive. So in this, following data were provided by the accounting records of XYZ Limited at year end March 31st, 2010. The particulars given are sales, which is at 6,98,000, cost of goods sold, which is 5,20,000, thus the gross margin is 1,78,000. Operating expenses, which includes depreciation expense of rupees 37,000, is 1,47,000. So thus friends, remember the significance of giving this depreciation expense is that while preparing the cash flow statements using the indirect method, we will have to adjust this non-cash item. Other income and expenses given in the question are interest expense paid 23,000, interest income received is 6,000, gain on sale of investments is 12,000, and then finally loss on sale of plant is 3,000. Just by reading this question, friends, you should be able to analyze that interest expense paid will be a financing activity, interest income received will be an investing activity, gain on sale of investments should be investing activity, loss on sale of plant should again be, the related receipts should in fact be investing activity. The net profit before taxation is given as 23,000, income tax of 7,000, and finally your profit available for appropriation is 16,000. So friends, in this illustration, the balance sheet has been given as follows. There is a comparative balance sheet given for both the years, which will help you to basically adjust for non-cash items and also adjust for working capital changes. So under equities and liabilities, liabilities and equity are given as share capital of closing balance of 4,65,000 and opening of 3,15,000, reserves and surplus, closing of 1,40,000 and opening of 1,32,000. Bonds is given as closing of 2,95,000 and opening of 2,45,000. Friends, here you should be able to quickly analyze that around 50,000 of bonds have been further raised. Current liabilities, accounts Payable is closing is 50,000 and opening was 43,000. Thus there is a net increase in accounts payable and should be a net cash inflow while making an adjustment in the working capital changes. Similarly for other items. Accrued liabilities from opening of 9,000 to closing of 12,000. Income taxes payable is 3,000 and 5,000. Remember friends, in this example of income taxes payable, and since income tax provision is given in the question and there is no advance tax mentioned on the asset side, we will have to find out the adjusted cash payment figure, which will be again the opening balance plus the expense during the year less the closing balance. On the non-current asset side, we have plant assets of 7,15,000 and 5,05,000, less accumulated depreciation of 1,03,000 and 68,000 in the previous year. Thus, the closing balances of plant assets are 6,12,000 in the current year and the opening balance was 4,37,000. We should go and read through the adjustments given at the end of the question to better be able to understand plant and asset section. Investments long term, the opening was 1,27,000 and closing is 1,15,000. Thus there is a difference and subject to any other adjustments, we should look at this. Current assets, inventory has increased from 1,10,000 to 1,44,000 and thus should be a cash outflow. Accounts receivable from 55,000 to 47,000. Since there is a decrease, it should be a cash inflow. Cash will be used in opening and closing balance of the cash flow statement. Prepaid expenses have been given as 5,000 of opening and 1,000 of closing. So after this, let's see if any adjustments have been given in the question. So friends, further adjustments given in the question are as follows. Analysis of selected accounts and transactions during 2009-10 revealed that the entity had purchased investments for rupees 78,000, sold investments for rupees 1,02,000. These investments cost rupees 90,000. Thus, you would be able to see a profit of 12,000 in the profit and loss statement. The company purchased plant assets for rupees 1,20,000, sold plant assets that cost rupees 10,000 with accumulated depreciation rupees 2,000 for rupees 5,000. Thus, in this case, rupees 5,000 should be used as a cash inflow. This is the main cash inflow to be used while preparing the cash flow statement. While to comprehend the entire transaction, if you remember, there was a loss of 3,000 due to sale of plant and this adjustment kind of reiterates that. So if you see 10,000 less 2,000 accumulated depreciation is 8,000 and 5,000 it has been sold for, thus there is a loss of 3,000. Company had issued rupees 1 lakh of bonds at face value in an exchange for plant assets on 31st March 2010. Now this adjustment, my friends, is very important. Why? Because this adjustment does not require any adjustment in your cash flow statement preparation. So if you really read it carefully, there is no cash inflow or outflow in this adjustment. It is just an exchange of bonds against the plant assets on 31st March 2010. So please remember, carefully read the adjustments, and if no cash inflow or outflow is there, that should not be adjusted. As per Accounting Standard 3 and as we discussed, this should form part of your notes to accounts and a separate disclosure regarding these non-cash transactions should be given. The company repaid rupees 50,000 of bonds at face value at maturity, which explains the difference between the opening and closing balance, and this should form part of your financing activity. Issued 15,000 shares of rupees 10 each. This should explain the difference in the equity share capital. Paid cash dividends of rupees 8,000. Now this is not part of your profit and loss statement because it stopped before appropriations. So this is a kind of appropriation and should again form part of your financing activity. Question is, prepare cash flow statement as per AS3 using the indirect method. Since all the information is given which would help in preparation of cash flow statement using indirect method. So let's do that. So friends, the cash flow statement of XYZ Limited for the year ended 31st March 2010 will be prepared in this manner. So we'll have particulars starting with cash flow from operating activities. Again, as we discussed earlier, we'll under the indirect method we'll start with net profit before taxation. Then we'll adjust for the adjustment given, depreciation which was given in the question itself as forming part of the operating expenses is 37,000. Gain on sale of investments again appearing in the profit and loss statement is 12,000. Now since this 12,000 helped you to increase the net profit, now it should be decreased. Loss on sale of plant assets is 3,000. It reduced the profit, now it should be added back. Interest expense of 23,000. It reduced the profit, now it should be added back. Similarly, interest income given in the question of 6,000 helped you to increase your profit, now it should be reduced. Thus, we will reach at operating profit before working capital changes of 68,000. Now we'll make adjustment for working capital changes. Decrease in accounts receivable from 55,000 to 47,000 results in a cash inflow of 8,000. Increase in inventory from 1,10,000 to 1,44,000 has resulted into a cash outflow of 34,000. Decrease in prepaid expenses has resulted into a cash inflow of 4,000. Increase in accounts payable from 43,000 to 50,000 is as a result of no payment during the year, and further accrual of accounts payable has resulted in a cash inflow of 7,000. Similarly, for increase in accrued liabilities from 9,000 to 12,000 has resulted into a cash inflow of 3,000. Thus the cash generated from operations is 56,000 after adjusting for working capital changes. Now the income tax paid, we'll see this working later, is 9,000, but for your understanding it's the same thing. It's the income tax provision during the current year plus the opening balance of income tax provision less the closing balance of income tax provision will give you the cash outflow due to income taxes paid during the year. Thus the net cash generated from operating activities is 47,000. Now we will see cash flow from investing activities and cash flow from financing activities, and whether the total of these three activities plus the opening balance would give us the closing balance, and this will how we will be able to reconcile our answer. Thus the cash flow from investing activities would have the following items. This is how it is required to be prepared while preparing your answers. Purchase of plant assets as given in the adjustment is 1,20,000. Sale of plant assets, the amount you received and not the profit and loss on the plant assets is 5,000. Purchase of investments is 78,000. However, the sale of investments as given in the question is 1,02,000. Interest received is a cash flow from investing activities which we adjusted in the net profit before tax in operating activities is now shown here as a 6,000 positive item, which is a cash inflow. Thus net cash used in investing activities, because it's a negative item, is thus used in investing activities is 85,000. Now let's see cash flow from financing activities. Proceeds from issuance of Share capital as given in the question is 1,50,000. Repayment of bonds is again 50,000. Interest paid, which we added back in the net profit before taxes in operating activities, is now shown here as a cash outflow. Dividends paid as given in the question is shown here as 8,000. Thus the net cash from financing activities again upon a positive item of 69,000. Once we total up these three activities, the net increase in cash and cash equivalents is 31,000. We add this to cash and cash equivalents at the beginning of the period and arrive at the cash and cash equivalents at the end of the period. Since these are reconciling, our answer looks correct, but at the same time, one should be sure what we are including in investing, financing, and operating activities to get the full marks in the examination. So friends, we saw a working note being written in the answer for income taxes. Thus this is the working note. We see the income tax expense for the year as given in the profit and loss account is 7,000. Add income tax liability at the beginning of the year, 5,000, less income tax liability at end of the year, which is 3,000, will give us the cash outflow during the year of 9,000. This is how income taxes paid is required to be presented, and using this we are able to calculate the income taxes paid during the year and adjust that in our cash flows from operating activities. So friends, after doing these two illustrations and after going through the accounting standard in its entirety, I think this will give you more confidence. So let's come down to disclosures, which is the last item in our agenda. How these cash flow statements are required to be disclosed and what are the other items which are required to be disclosed along with the cash flow statement. This will help us to understand. So under the disclosures, an enterprise needs to disclose the amount of significant cash and cash equivalent balances held by it but not available for its use, together with a commentary by management. Thus there might be a lot of cash and cash equivalents which might be kind of on lien. So for example, fixed deposits might be on lien with other banks on which they might have taken a demand loan or for example would have kind of given as a guarantee and thus are not readily available for use by that entity. Such cash equivalents or cash are required to be disclosed separately, that these are on lien or are under guarantee and are not readily available for use by the management. Disclosures relating to additional information relevant for understanding the financial position and liquidity of the enterprise should be included. Such information may include the amount of undrawn borrowing facilities that may be available for future operating activities and to settle capital commitments, indicating any restrictions on the use of these facilities. Thus, if a company has taken a borrowing facility of say 100 crores, but it has just utilized 10 crores out of it, the company should under its notes to accounts disclose the fact that it has the borrowing facility of 100 crores, however, it has just utilized 10 crores out of that borrowing facility, and it should also give if there is any restriction on the use of these facilities. For example, the bank may give a clause that after 40 crores you will have to necessarily give information about your future sales, your current sales, etc. And thus such restrictions on the use of these facilities should also be given. The aggregate amount of cash flows required for maintaining operating capacity, for example purchase of machinery to replace the old, separately from cash flows that represent increase in operating capacity, example additional machinery purchase to increase production, should be disclosed. Thus cash flows